Hi there and welcome to the Stockscores Market Minutes for October 11th, 2013. This week I'm going to talk about the exit strategy, which is an often overlooked part of the equation in trades. How do we know when to sell our winners? Stocks that trend higher need some room for pullbacks in the trend. You will see virtually every strong trending stock have periods when they run up and then there's a pullback. And we need to allow some room for that pullback to happen. What's important is to recognize that when pullbacks are greater than expected, the market is telling you it is time to sell. Now we can use the stock's historic volatility and trend to determine what is a reasonable pullback versus a signal to sell. Ultimately, we want to exit stocks either when they break the upward trend line or when they pull back below a reward for risk line. Now I'll show you what reward for risk lines look like in just a moment, but they are defined by the volatility of a strong daily move or weekly gain, or even if you're intraday trading, a strong intraday gain on a 2-minute, a 5-minute, a 13-minute chart, whatever you like to look at. So let's go through some examples. We'll start with trend lines first. Here's a chart, a weekly chart of Tesla, and you can see that it has a very well-defined linear trend line on the weekly chart, starting its upward trend in April. And on numerous occasions, the stock would have 3 or 4 weeks of up move followed by a pullback, 3 weeks of up followed by a pullback. And we see that over and over again. And right now, this stock is in pullback mode where it has come back to the upward trend line. Now, it actually went through the upward trend line intra-week. So in the middle of this week, it actually fell down below that trend line, but it came back by the end of the week to hold above the trend line. And therefore, if you are a longer term trader on Tesla, there is still no signal to sell. Now certainly the break of the trend line intra-week and the fact that we're right at that trend line right now is cause for concern. We could get that breakdown in the next week or two, but for right now the trend line has not been broken, and so using that method we should still be in the stock. Now let's turn our attention to the reward for risk method. What I do with reward for risk is I look for a break from low volatility, and I define my reward for risk lines, and we're going to start with the the blue and the red lines on this chart as our large scale volatility. So going back into October 4th, just take a look at the chart, find October 4th, you'll see that I've got the blue line cutting across that tall candle on October 4th right here. And I then put my red line at the floor before that break. So the distance between those lines represents an abnormal amount of volatility. You can see that that was the first break when the buyers got excited. Now, if that is an abnormal amount of volatility, then it stands to reason that if we were to pull back by that same multiple, it might imply that something really negative is going on. And so what I do is I draw multiple risk-reward lines. Each one of these green lines is a multiple of reward for risk that represents that big volatility that happened on this stock. Now in this particular case it's a 60-minute chart, but you can apply this same method to a weekly chart, a daily chart, even a monthly chart. Just pick a zone where the market broke from low volatility and define the width of those lines as the difference between the close on the big break from volatility and the support area in that chart. Now, every time the stock closes above a line, you move your stop to the line below. So here we have a line, we closed above it, so our stop is one line below. We close above it, our stop is one line below. So we're always trailing our stop, and really that's what this is a form of a trailing stop loss. But what's critical is that the trailing amount, the amount of price difference we have between the stock and where our stop is based on the historic volatility of the stock. We look for the big up days, we find support after or just leading into the big up day, and we say that's the abnormal volatility, and that's what we're going to use to measure our pullbacks. And in this case, this stock is still not given an exit signal because it is not pulled back through a line after one of the upper lines was closed. Right now our stop on this particular situation would be right here, just below $6, because we've closed above this line and we are now looking for a pullback to come down through there. Now, once we close above $7, then we're going to move our stop up to just below $6.50. All right, now how do you draw these lines? I'm going to show you that next. We jump into Stockscores and we can pull up that chart, ALTI. Now below the chart, when you're in large chart view, you can go down below the chart, select chart, and you'll see at the bottom of our charting tab we have right here the risk reward boxes, and we can type in the entry price. Let's type in 3.05, stop loss price of 2.55, and then click on create chart, and it now draws those lines for us. Now right now I've got a daily chart. If I wanted an intraday, I go 1 month, 60 minute, click on 60 minute. Now I've got my intraday 60-minute chart with those reward for risk lines drawn just as I had done in the presentation. Alright, so that's how we use the Stockscores.com website to draw risk reward lines, and you can also use this on Tradescores, and when you're playing the trading simulator on Tradescores.com, those risk reward lines will automatically be drawn based on your entry price and your stop loss price. Alright, let's get into the analysis. S&P 500 broke through its upward trend line this week, but it didn't stay below that line, and so on the weekly chart time frame, which is what I have here, you can see that the upward trend line remains intact. Now we had a pretty good scare midweek, and all of the volatility certainly made me cautious in my trading this week, but we have held that upward trend line, and therefore we must remain bullish. It is somewhat concerning, A, that we broke the upward trend line intra-week, and also the fact that the tops are not rising as quickly as the bottoms. That is a sign that the buyers are getting a little bit exhausted. That may only mean that we're going to go into a period of sideways trading, but for now the upward trend is in place and we should remain bullish. A great week for the TSX because it broke its 4 or 5 week downward trend, and it's a very minor downward trend at that. You can see it on this weekly chart over the last 4 or 5 weeks. But what I like about this chart is we're building a head and shoulders bottom. I've highlighted the 2 shoulders, left and right, and the head. Those are in green. Our neckline is in the red line, and if we can break through that, and really we're 1 week away from doing that, if we can have another strong week, then we're off to the races and the Canadian market can finally start to catch up with the US market. 20-year bonds have broken their downward trend line, at least on a short-term basis, and I think will likely rally up to the longer-term downward trend line. So in the very long-term sense, I remain bearish on US Treasuries, but in the short term, I think this market will rally and sort of come back from some oversold conditions. Now keep in mind that a rising price in Treasuries means a lower interest rate, so that's also good for the economy and the housing market, that sort of thing. Chinese market broke from a flag this week. It still hasn't got through its resistance. In some ways a very similar situation to the Canadian market, and that's no accident. The Canadian market, because of its heavy emphasis on commodities and the fact that China is the big consumer of commodities, they're going to always have some correlation where if the Chinese market is getting better, that will benefit the Canadian stock market as well. Also benefiting the Canadian stock market is emerging markets in general. And here we can see the emerging markets ETF, EEM, breaking its downward trend line this week, and it looks to me like we're starting to see that recovery globally in the economy, and that's going to help all stock markets, but in particular some of those markets that have really lagged the US market, like the Canadian stock market. US dollar has fallen to support and intra-week gone through support, but it's still holding that support line, which I have drawn in green, and so we should not suggest that the US dollar is yet ready to make that next leg down. We could hold here for some time, and so I would say I'm cautiously neutral on this one. Not optimistic because there still is a downward trend in place and we have pessimism, but we should also hold that support line, so we could see a little bit of a bounce back in the US dollar. Gold continues its downward trend. It rallied back to the trend line through the summer. It's hit that trend line and really can't find a buyer, and it looks to me like gold is more likely to head lower than higher. Oil stuck in a sideways trading range at the bottom of that range where it should hold support. So far it has done so, but some caution is warranted. If we get a break below 24 on the OIL ETF, then we should expect a move lower, probably to the $22 to $21 mark. And finally, the VIX pulled back this week, well, after rallying at the start of the week on the breakdown that we saw in the overall stock market, as things start to get sorted out in the US government and their debt situation. We saw the VIX make a really sharp pullback, and it remains stuck in that trading range, and I think it's going to cool down. But with that said, there's still lots of uncertainty in the US, so I think short-term traders can trade the VIX or the VXX because there will be volatility, but I don't recommend holding those positions overnight because we get surprises very quickly. One person puts out a headline and you can be whipsawed out of a position very quickly. So US stocks, I am bullish. Neutral on Canadian, but really looking towards a breakout there. Bearish on gold and neutral on oil. US stocks flirted with their upward trend line this week, but have held the optimism. Canadian markets broke higher and are once again testing resistance and appear poised to break out. Gold can't catch a bid and oil looks likely to be range bound in the near term, although a bounce off support in the near term is also likely. Well, that has been the Stockscores Market Minutes for October 11th, 2013. Have a great long weekend to the people in Canada, and have a great week trading. To everyone else, trade well.